Judith wrote the check on a Tuesday morning in October. She sat at her kitchen table in Bendigo with a cup of tea going cold beside her, and she wrote her daughter's name on the check, and she wrote $80,000 in the amount field, and she felt good about it. She felt like a mother. She felt like someone who had worked hard and saved carefully and was now able to do the thing she had always wanted to do. Help her daughter into a home before the market moved any further out of reach. Her daughter Alicia was 34. She had a partner. They had a deposit saved, but not quite enough. The gap between what they had and what the bank needed was exactly $80,000. Judith had the money sitting in a term deposit. She was 71. She owned her home. She was on a part pension. She was comfortable. The $80,000 would not change her life. It would change Alicia's. So she wrote the check. She told her financial advisor about it at their next annual review 3 months later. The advisor went quiet. He pulled up his calculator. He asked Judith when exactly she had made the transfer. Judith told him. October. First week? The advisor looked at the screen for a long moment. Then he looked at Judith. He said, Judith, Centrelink is going to treat this as a deprived asset for 5 years. Your pension is going to be reduced, not by a little, by enough that you will feel it every fortnight for the next 5 years. And there is nothing we can do about it now because the money is already gone. Judith stared at him. She said, I gave my daughter money for a house deposit. How is that deprivation? The advisor said, because in Australia, when you are on the pension and you give away money above the threshold, Centrelink assumes you did it to get a higher pension, and they act accordingly, whether that was your intention or not. Judith drove home from that appointment feeling something she had not felt in a long time. She felt foolish. She was not foolish. She was generous. She was a mother who loved her daughter and wanted to help her. She had simply never been told about a rule that has been sitting in the Social Security Act since 1991 and that catches thousands of Australians every single year. My name is Mitchell Levi, and what happened to Judith is happening to Australian families right now. This week, in kitchens, in Bendigo and Ballarat and Blacktown and every suburb and town in between, where a parent who worked hard and saved carefully wants to do something meaningful with that money before they die. The instinct is right. The execution without knowing the rules is devastating. If you are on the age pension or approaching pension age, if you have superannuation, savings, or a home and you are thinking about transferring any of it to your children, if your parents are pensioners and you are expecting a gift or a loan from them, what I am about to explain affects your family directly and immediately. The gifting rules in Australia are not widely understood. The 5-year deprivation rule is not explained at the point of transfer. Centrelink does not ring you before you write the check. They calculate the penalty after the money is already gone. But here is what most people who talk about this rule miss, and this is the part I want you to stay for. Because the gifting rules are only half the story. The other half is the set of legal structures that exist specifically to transfer wealth to your children without triggering the deprivation rule, without reducing your pension, without Centrelink counting a single dollar of what you transferred. These structures are used every day by families who know about them. They are completely unavailable to families who don't. Later in this video, I'm going to show you 3 structures that Judith could have used. Structures that would have put the same $80,000 into Alicia's hands without costing Judith a single dollar of pension. And I am going to show you the rule that makes the difference between a transfer that cost you 5 years of reduced pension payments and one that cost you nothing. Let me explain exactly how the gifting rules work in 2026, because the vague version, the version most people have heard, is not precise enough to protect you. Under the Social Security Act 1991, Centrelink applies what is called the deprivation provisions to any transfer of assets or money that a pensioner or pension applicant makes below market value or for no consideration. In plain language, if you give something away or sell it for less than it is worth, Centrelink treats the amount given away as if you still have it. For the purpose of calculating your pension entitlement, the gifting threshold in 2026 is $10,000 per financial year and a maximum of $30,000 over any rolling 5-year period without Centrelink counting the gifted amount as a deprived asset. These numbers have not changed in years. They were set when $10,000 was a meaningful amount of money and $30,000 was a serious sum. In 2026, with property deposits running at $80,000 to $150,000 in most capital cities, the thresholds are almost insulting in their inadequacy for what families are actually trying to do. But inadequate or not, they are the law. Anything above $10,000 in a single financial year or above $30,000 across 5 years is classified as a deprived asset. Centrelink adds that amount back to your assessable assets and assessable income using the deeming rate. The deemed income from the deprived asset reduces your pension payment, and it keeps reducing it for 5 years from the date of the gift. Now let me show you what Judith's $80,000 gift actually cost her. Judith gifted $80,000. The allowed threshold was $10,000. The deprived amount was $70,000. Centrelink applied the deeming rate to $70,000 of deprived assets. In 2026, the lower deeming rate is 0.25% on the first $62,600 of financial assets for a single pensioner and 2.25% on amounts above that. Anything above $10,000 in a single financial year or above $30,000 across 5 years is classified as a deprived asset. Centrelink adds that amount back to your assessable assets and assessable income using the deeming rate. The deemed income from the deprived asset reduces your pension payment, and it keeps reducing it for 5 years from the date of the gift. Now let me show you what Judith's $80,000 gift actually cost her. Judith gifted $80,000. The allowed threshold was $10,000. The deprived amount was $70,000. Centrelink applied the deeming rate to $70,000 of deprived assets. In 2026, the lower deeming rate is 0.25% on the first $62,600 of financial assets for a single pensioner and 2.25% on amounts above that. The deemed income from $70,000 reduced Judith's fortnightly pension payment by approximately $45 to $55 per fortnight, depending on her other assets and income. Over 5 years, 130 fortnights, Judith's total pension reduction is approximately $5,800 to $7,100. Not catastrophic, but real and entirely avoidable. Now let me show you what happens when the gift is larger, because Judith's situation is actually the mild version of this problem. Robert is 74. He lives in regional Queensland. He has $340,000 in superannuation, a home worth $580,000, and $60,000 in savings. He is on a part pension. His son needs $200,000 to buy out a business partner. Robert wants to help. He transfers $200,000 from his super to his son's account. The deprived amount is $190,000. The $200,000 transfer minus the $10,000 annual threshold. Centrelink deems income on $190,000 of deprived assets and reduces Robert's pension accordingly. His fortnightly pension payment drops by approximately $170 per fortnight. Over 5 years, his total pension reduction approaches $22,000. But it gets worse, because the $200,000 withdrawal from super also reduces Robert's balance. His fund earns less. The compounding effect on his remaining super is reduced for the rest of his life. The total cost of the gift, accounting for lost pension payments and lost super earnings, is closer to $35,000 to $45,000 over the period. Robert wanted to give his son $200,000. He gave his son $200,000. But the real cost of that transfer, the amount it took out of Robert's retirement, was closer to $240,000. Nobody told Robert the rule existed before he made the transfer. Now let me introduce you to Frank and Glennis. Frank is 69. Glennis is 67. They live in a suburb of Adelaide. They have a combined superannuation balance of approximately $520,000, a fully paid off home worth $740,000 and $45,000 in a savings account. They are not yet on the pension. Frank is still working 3 days a week as a consultant, but he is winding down and they are expecting to apply for the age pension within the next 12 to 18 months. They have 3 adult children. One of them, their youngest Daniel, is struggling. He went through a divorce 2 years ago. He has 2 kids. He is renting. He cannot get a loan because his income is irregular. Frank and Glennis want to help him. They had planned to give Daniel $150,000 when they retired. A combination of love and practicality. Get him back on his feet before the pension complicated things. What Frank and Glennis did not know was that gifts made in the 5 years before a pension application are captured by the deprivation provisions, just as if they had been made after the pension started. The 5-year look-back is the rule that catches people who think they are being smart. Centrelink does not just look at what you gave away after you went on the pension. They look back 5 years from the date of your pension application. Any gifts above the threshold made during that window are assessed as deprived assets. If Frank and Glennis give Daniel $150,000 today and they apply for the pension in 18 months, Centrelink will count $140,000 of that gift as a deprived asset at the time of their application. It will reduce their assessed pension from the day they apply, before they have even received a single payment. The penalty follows the gift. Not the application date, not the pension start date. The gift? Frank and Glennis were 2 months away from making that transfer when their daughter, who works in financial services and happened to be visiting for Easter, asked a single question at the dinner table. Have you spoken to a pension specialist before you do this? They hadn't. They did. The specialist showed them 3 structures. Structures that achieved exactly what Frank and Glennis wanted. Money in Daniel's hands. His situation stabilized. The family helped, without a single dollar of it triggering the deprivation provisions. Let me walk you through those 3 structures now. The first structure is the formal loan agreement. Same money, different legal relationship, 0 deprivation. A gift is a transfer with no expectation of return. Centrelink counts it as deprivation. A loan is a transfer with a documented expectation of repayment. Under current Centrelink rules, a genuine documented loan to a family member is treated as an asset, a receivable, rather than as a gift. It remains in your assessable assets as a financial asset. It does not reduce your pension because it has not reduced your asset pool. You have simply changed the form of one asset from cash to a loan receivable. For Judith, instead of writing an $80,000 check as a gift to Alicia, Judith could have written an $80,000 check under a formal loan agreement. Alicia receives the same $80,000. She buys the same house. The bank sees the same deposit, but Judith's Centrelink assessment shows an $80,000 loan receivable rather than an $80,000 deprived asset. Her pension is untouched. What makes the loan genuine for Centrelink purposes? The loan must be documented in writing before the money transfers, not reconstructed afterwards. Before. The document must specify the amount, the date, the repayment terms, and the interest rate, if any. Interest is not required. A zero-interest family loan is acceptable, but the repayment terms must be realistic, and the loan must be genuinely intended as a loan, not a gift in disguise. Centrelink has seen enough paper loans that are actually gifts to be skeptical. If the repayment terms are vague or the loan is never actually tracked, Centrelink may reclassify it as a gift on review. The protection is in the documentation and the genuine intention. Use a simple written loan agreement. Specify repayment terms that are actually achievable. Keep a record of any repayments made. For Frank and Glennis and Daniel, a $150,000 formal loan to Daniel, documented before transfer, with a repayment schedule of $500 per month, keeps $150,000 on their asset schedule as a receivable. Their pension application proceeds without the deprivation shadow. Daniel has the money. The family is helped, and the loan, if they choose to forgive it in their will, converts to a bequest at that point. Well outside the 5-year deprivation window. The second structure is the granny flat interest. A granny flat interest is an arrangement where a pensioner transfers assets, typically their home or a significant sum of money, to a family member in exchange for a right to accommodation for life. Under Centrelink's guidelines, a genuine granny flat interest is not assessed as a gift. It is not treated as deprivation. The transfer of the asset is considered to be exchanged for something of genuine value. The right to live somewhere for the rest of your life. The assessment of whether the exchange is reasonable is done by Centrelink using what is called the reasonableness test, a formula based on your age and the transfer amount that determines whether the accommodation right you received is a fair exchange for what you gave. How this works in practice: a parent who wants to transfer wealth to a child who owns a property can contribute a significant lump sum to that child in exchange for a formally documented right to live in a room or granny flat on the child's property for life. The parent's contribution is assessed by Centrelink against the reasonableness test. If the assessed value of the lifetime accommodation right equals or exceeds the contribution amount, no deprivation occurs. The parent has not given anything away. They have purchased something. For the child, they receive the capital contribution and provide accommodation. For the parent, they have transferred wealth to the next generation without pension penalty and have secured their own accommodation arrangement as circumstances change. The granny flat interest must be documented in a written agreement before the transfer. Centrelink has tightened documentation requirements significantly in recent years. The agreement must specify the right to accommodation, the conditions, and what happens if the arrangement ends. For example, if the parent needs to enter residential aged care. A solicitor familiar with granny flat interest agreements is essential here. The cost of getting the document wrong is the full deprivation penalty on the transferred amount. The third structure is the superannuation tax-free withdrawal combined with a formal loan. This is the most powerful of the three for families where the parent has significant superannuation and the child needs capital now. Most people think of superannuation as a retirement savings vehicle, which it is, but it is also one of the most tax-effective wealth transfer mechanisms available in Australia if used deliberately. Here is how the combination works. The parent, if between 60 and 75, withdraws from superannuation as a lump sum. Withdrawals from super after age 60 are completely tax-free. No income tax, no capital gains tax. No Medicare levy. The money comes out clean. The withdrawn amount is then not gifted to the child. It is loaned under a formal loan agreement as per Structure 1. The parent retains a loan receivable on their asset schedule. The child has the capital they need. Why this matters beyond just avoiding deprivation: the parent's superannuation balance is reduced by the withdrawal. A lower super balance means lower means-tested exposure if aged care becomes relevant later. The family has moved wealth efficiently across a generation using the tax-free withdrawal window. And the loan structure keeps everything clean for Centrelink. Now here is the combination that changes everything for Frank and Glennis. Frank is 69 with $280,000 in super. He withdraws $150,000. Tax-free. He and Glennis document a formal loan to Daniel for $150,000 under a written agreement. Daniel has his money. Frank's super balance is now $130,000, which means his means-tested exposure for future aged care is lower. His pension assessment shows a $150,000 loan receivable, an asset, not a deprived amount. His pension continues unchanged. In 5 years, if Frank and Glennis want to forgive the loan, they can gift $10,000 per year per person of that debt, reducing Daniel's repayment obligation progressively within the annual gifting threshold. Two people gifting $10,000 per year equals $20,000 of loan forgiveness per year within the threshold. The $150,000 loan is fully forgiven within 8 years, all within Centrelink's rules. This is not complicated when you see it laid out, but it requires knowing all three pieces exist and how they connect. Let me be honest with you about something. The deprivation provisions in the Social Security Act are not secret. They are not buried. They are on the Services Australia website. They are in Centrelink's published guides. They are mentioned in the information pack that pension applicants receive. They are mentioned, but they are not explained. Not in the way that would change behavior before the check is written. The information pack Judith received when she first applied for the pension ran to 37 pages. The gifting rules were on page 22. They were described in 3 paragraphs. The paragraphs were accurate. They were also written for compliance purposes, not for comprehension. Nobody reads page 22 of a 37-page government information pack when they are 71 years old and helping their daughter buy a house. And nobody from Centrelink rings you before a transfer to say, before you do this, have you thought about the pension implications? They calculate the penalty after. They reduce the payment the following fortnight. And they send you a letter explaining the adjustment in language that is accurate and incomprehensible to anyone who has not already had the specialist conversation. The system is not cruel. It is indifferent. It does not distinguish between Judith, who gave $80,000 to her daughter out of love, and a pensioner who gave $80,000 to reduce their assets and access a higher pension. The rule treats both the same. The formula does not ask why. The deprivation provisions exist because without them, pension means testing would be trivially circumventable. The rules are there for a reason. But the gap between the rules existing and the people most affected by them understanding how they work costs Australian families tens of millions of dollars every single year in reduced pension payments that were never necessary. That gap is what this channel exists to close. Now let me give you the timing framework because the window matters and I want to be specific. If you are not yet on the pension and are more than 5 years from application, you have maximum flexibility. Gifts made more than 5 years before your pension application are outside the deprivation look-back window. The formal loan structure and granny flat interest are still worth using for good documentation practice, but the urgency is lower. Use this window to get your estate plan in order and have the specialist conversation before you are inside the 5-year zone. If you are not yet on the pension and are within 5 years of application, this is the critical window. Every transfer you make right now is inside the look-back period at the time you apply. Do not make any significant transfer to a family member without first understanding whether it will be classified as deprivation. The formal loan structure must be in place before any money moves. If you are already on the pension, the deprivation provisions apply from the date of any gift above the threshold. The 5-year clock starts immediately. The formal loan structure is still available for future transfers. Past gifts cannot be reversed, but their impact can be understood and factored into future planning. If your parents are pensioners and approaching a transfer decision, the conversation needs to happen before the money moves, not after, not simultaneously. Before, a phone call to a pension and social security specialist costs a few $100s. The cost of the wrong decision can be measured in thousands over 5 years. Here is what I want you to actually do after watching this video. If you are a pensioner or within 5 years of pension age and you are planning any transfer of money or assets to a family member above $10,000, stop. Do not make the transfer until you have spoken to a social security specialist or financial advisor who specifically understands the deprivation provisions. This conversation costs a fraction of what the wrong decision cost. If you have already made a transfer that may have triggered deprivation, contact Centrelink and get the assessment in writing. Understanding exactly how much your pension has been reduced and for how long allows you to plan around it. Surprises on the pension statement are always more expensive than known adjustments. If you want to help a family member with a significant amount of money, explore the formal loan agreement structure before any other option. It is the simplest, most defensible, most flexible structure available. Get it documented by a solicitor before the money moves. If you own your home and your child owns their home, ask a specialist whether a granny flat interest arrangement is appropriate for your family structure. It is not right for every family. But for families where the parent is approaching the point where they may need to live with or near a child anyway, it can be the most elegant solution available. If you have superannuation above $200,000 and you are between 60 and 75, ask an advisor specifically about the tax-free withdrawal and formal loan combination. The tax-free withdrawal window is one of the most underused wealth transfer mechanisms in Australia. It closes at 75. Use it deliberately. Judith still thinks about that Tuesday morning in October. She still thinks it was the right thing to do. Alicia has the house. Alicia is building something. The deposit Judith gave her was the difference between a life with a foundation and a life spent chasing one. Judith does not regret the gift. She regrets that nobody told her she could have achieved exactly the same outcome. Alicia, with the same $80,000, the house deposit in place, the future secured, without losing a single dollar of her pension. Not because the rules were secret, because the conversation never happened before the check was written. Somewhere right now there is another Judith. She is 68, or 71 or 74. She has worked hard. She has saved carefully. She has a child who needs help and the means to provide it and the love to want to. She is thinking about writing a check. And nobody has told her yet about the rule on page 22. You now know about the rule on page 22. More importantly, you now know about the 3 structures that make the rule irrelevant. That lets you help your family the way you want to help them. Legally, permanently, without Centrelink counting a dollar of what you transferred. Share this video with your parents tonight. With your siblings, with anyone you know who is on the pension or approaching it and has money they want to pass on. One conversation before the check is written changes everything. One conversation after changes nothing. This is Mitchell Levi. I will see you in the next one. Or 71 or 74. She has worked hard. She has saved carefully. She has a child who needs help and the means to provide it and the love to want to. She is thinking about writing a check. And nobody has told her yet about the rule on page 22. You now know about the rule on page 22. More importantly, you now know about the 3 structures that make the rule irrelevant. That lets you help your family the way you want to help them. Legally, permanently, without Centrelink counting a dollar of what you transferred. Share this video with your parents tonight. With your siblings, with anyone you know who is on the pension or approaching it and has money they want to pass on. One conversation before the check is written changes everything. One conversation after changes nothing. This is Mitchell Levi. I will see you in the next one.